It really feels like the whole landscape of global trade is, well, it's shifting under our feet right now.
It really does.
We're not just talking small adjustments. These are some pretty big, significant moves impacting economies all over the world.
Absolutely. And today we're going to dig into two main areas based on that really interesting info you shared.
Yeah, first up, those growing tensions, right, between the EU and China. Specifically, these claims about China dumping goods in Europe.
Jumping, exactly.
Yeah.
And then the second big piece is Canada. It looks like they're making a strategic pivot with their energy exports, looking much more towards Asia, especially with some of the trade uncertainty with the U.S.
Right, and digging into this broader theme just kept popping up. How tariffs and these trade spats are increasingly being used as like geopolitical chess pieces.
Yeah, it's like the go-to tool now.
We're seeing it with the U.S., the EU, Canada, China. It involves everyone.
And what's really striking is how connected it all is. An action over here can send ripples, sometimes pretty big waves, across the globe, often in ways you wouldn't expect.
Totally. So our mission today really is to unpack all this complexity. We want to get past the headlines, pull out the key insights, look at the numbers, the politics behind it.
And figure out what it all means. For the global economy, sure, but also, for regular people, for consumers.
Exactly. Okay, let's jump right in. EU-China trade friction. It sounds like the U.S. China tariff stuff really sort of kicked this off.
That seems to be the initial spark, yeah. As the U.S. put up those higher tariffs on Chinese goods, it looks like China shifted some of that export muscle towards Europe instead.
And Europe's definitely noticed the change in trade patterns. The data you mentioned really shows that, doesn't it?
Oh, clearly. If you compare, say, the last quarter of 2024 with the first quarter of 2025, imports from China into the EU jumped up by 6%.
6%, okay.
And at the same time, EU exports to China, they actually dipped on average about 3%. What's really telling is the market share, Chinese textiles, consumer electronics, they're grabbing close to 10% of the European market now.
Wow, nearly 10%. That's not insignificant.
Not at all. It's a real shift in who's competing against whom.
And I bet European manufacturers are feeling that pressure, especially in certain sectors.
Precisely. You hear from France, Germany, Italy, particularly in textiles, footwear, even things like washing machines, white goods. They're saying, look, we just can't compete with these Chinese prices.
Which brings us to that term dumping.
Exactly, dumping.
And just to clarify for everyone, that's basically selling goods abroad for less than you sell them at home. Right. Sometimes even below what it costs to make them.
That's the core idea. And the suspicion in the EU is that China might be doing this strategically.
To gain market share.
Potentially. Sell low now, maybe even take a loss, drive out the European competition, and then, dominate the market later. We've even heard from some UK retailers pointing fingers at things like trade loopholes, tax breaks on small packages coming in.
The low-value consignment relief.
Stuff like that. They argue it gives Chinese online sellers an unfair edge.
And that example you gave is pretty stark, a product costing €105 locally, but you can get it shipped from China for €34, including shipping.
Yeah, it makes you wonder, doesn't it? How is that price possible?
Right. Is it just lower costs and efficiency, or is something else going on?
Well, things like tax breaks, maybe lower labor costs, they definitely play a part.
Yeah.
But the sheer size of that price gap fuels the dumping suspicion.
Yeah.
It adds this whole other layer of concern for the European producers.
So how's China pushing back against these accusations? They're not just accepting them, surely.
No, not at all. They flatly deny the dumping claims. Their line is, our prices are competitive because our production costs are lower, and our supply chains are incredibly efficient.
Okay, so it's just good business, according to them.
And they see this export increase to Europe as just a normal post-pandemic shift in global trade, not some deliberate plot to undercut European firms.
And they've warned the EU off imposing tariffs, haven't they? Kind of drawn a line in the sand.
Absolutely. They talk about free and fair trade, and they definitely see any EU anti-dumping duties as protectionism, plain and simple. They've been quite clear about that.
So on the EU side, what are they actually thinking of doing? What are the options?
Well, the European Commission is actively investigating. That's step one. If they find what they consider solid evidence of dumping,
then what?
Then they can impose anti-dumping measures, which usually means slapping extra customs duties on specific Chinese goods, the ones they think are being dumped.
We've seen this before, right? With steel.
Solar panels. Exactly. Steel, solar panels. Those are past examples. Now, the focus seems to be shifting towards sectors like textiles, maybe small electrical appliances, toys, shoes.
Right, those consumer goods categories.
But like we said, Beijing would react very negatively. Retaliation is a real possibility.
No doubt. And it sounds like within the EU itself, not everyone agrees on how hard to push back.
That's a really key point. You've got countries like Germany and France with big manufacturing sectors. They tend to want stronger action to protect their industries.
Makes sense.
But then you have other members, maybe Nordic countries, some Eastern European ones, who might rely more on cheaper Chinese components or raw materials for their own factories.
Ah, so tariffs on Chinese goods could actually hurt their businesses by raising costs.
Precisely. So they might prefer a more flexible approach.
Right.
And this internal difference of opinion, plus the EU's whole consensus-based way of making trade decisions.
It makes acting quickly pretty difficult, I imagine.
It can, yeah. It's a complex balancing act.
So looking ahead, what are the potential fallout scenarios here? It feels like a fork in the road.
It really does. EU policymakers are in a tough spot. Protect domestic jobs and industry. Or let consumers benefit from lower prices, especially now with inflation and sluggish growth.
That's the dilemma.
And there are longer-term risks, too. If they don't act and European firms go under, you could see unemployment rise in those manufacturing regions. And ironically, prices might eventually go up if there's less competition.
Right, if the EU becomes too dependent on imports.
Plus, the risk of Chinese retaliation is huge. If China hits back at EU exports, big exporters like Germany think machinery, cars could really suffer.
So a potential tit-for-tat trade war. That could sour relations even further, couldn't it, given all the other geopolitical stuff and human rights concerns?
Definitely. It adds another layer of tension. Some analysts even think China might pull back investment from Central and Eastern Europe if the EU gets tough, which could cause more friction within the EU.
And the data showing those rapid import surges 12–15% in just 6 months for things like textiles and toys. While European production falls 5–7%, that paints a pretty urgent picture.
It really does. It highlights how quickly these shifts are happening.
And businesses in Europe, the smaller ones especially, they're getting louder about this.
Oh yeah, chambers of commerce, SMEs, particularly in Italy and Spain. They're calling on Brussels to close those tax loopholes, stop the dumping. They feel their survival is at stake. There were even rumors about workshops happening within the Commission, specifically looking at anti-dumping tools.
So the pressure is building internally as well. It really feels like EU-China trade is at a crossroads. Could be a major blow-up. Could be some kind of negotiated truce. Very uncertain.
Highly uncertain.
Okay, let's pivot now. Let's talk about Canada and this shift in its energy strategy. Canada's always been a big energy player, right?
Well, absolutely a giant. In 2024, they were, what, 4th globally for crude oil production, 5th for natural gas. They hit record oil production levels.
And traditionally, almost all that went south to the U.S.
Pretty much. Something like 90% of their oil exports historically went straight to the U.S. We even saw the U.S. importing record amounts of Canadian crude just last summer after that Trans Mountain pipeline expansion came online.
Right, the TMX. But it sounds like things are changing. Geopolitics, trade jitters with the U.S., that's pushing Canada to look elsewhere.
That seems to be the main driver. This looming threat, the talk of a potential 10% U.S. tariff on Canadian oil and gas, that kind of uncertainty makes diversification look pretty attractive.
So they're actively trying to find new customers, especially in Asia and maybe Europe, too.
Exactly. Asia's the big focus right now, but Europe is definitely on the radar for the longer term.
And this Trans Mountain expansion, TMX, that's the key piece of infrastructure enabling this shift to Asia.
It's absolutely critical. It basically tripled the pipeline's capacity up to 890,000 barrels per day now.
Wow.
And crucially, it gives Canadian oil a much more direct route to the Pacific coast. From there, it's relatively easy to ship it across to Asian markets that were hard to reach before.
But getting that pipeline expanded wasn't easy, was it? I remember hearing about delays and controversy.
Oh, it was a long, bumpy road. Proposed way back in 2013, faced tons of regulatory hurdles, legal challenges, major environmental opposition.
Right.
It got so difficult that the Canadian federal government actually bought the project just to make sure it got finished. They had to meet like 156 conditions from the energy regulator.
156? That's a lot of conditions.
Covering everything from environment to safety to indigenous consultations.
Yeah.
But yeah, still faced fierce opposition. And the cost, well, it ballooned from an estimated $7.4 billion originally to something around $34 billion.
Oof. $34 billion. That's a serious investment. But it's running now, and it's starting to connect Canada with those Asian buyers.
The early signs are definitely there. China, interestingly, has become a pretty major buyer already.
Hmm.
Over $2 billion worth of Canadian crude flowed through TMX to China just between May and November last year.
$2 billion in about 6 months. Okay.
And we're seeing serious interest from Japan and South Korea, too. Now, the pipeline isn't running completely full just yet, maybe a bit below initial hopes, but it's clearly working as that gateway to Asia.
And China's interest seems quite serious, right? This news about Rangshan Prochemical setting up shop in Calgary, that sounds like more than just casual buying.
That's a significant move, yeah. Rangsheng is a big independent refiner in China. Planting a flag in Calgary suggests they're looking for a long-term relationship.
Right.
They've already done their first public deal, buying crude from Suncor, shipment expected pretty soon by June. And interestingly, they're using FOB contracts.
FOB, free on board. What does that mean practically?
It basically means Rangsheng takes ownership and responsibility for the oil transport, insurance, risk as soon as it's loaded onto the ship in Canada. Gives them more control over where it ultimately goes, maybe reselling it, more flexibility.
Gotcha. And they put an experienced person in charge there too.
Yeah, Wang Zhao. Seems like they're serious about building up their North American operations.
So China's not just dipping a toe in the water. They're setting up infrastructure, making deals. And it's not just Rangshan.
Now, reports suggest Rangsheng is talking to, partnering with other big players in Canada too, Canadian firms, international ones. It really reinforces this idea that China's becoming a steady, significant customer for Canadian heavy sour crude thanks to TMX.
Beyond China, what else is Canada doing to diversify? Are they looking at other Asian countries? Or maybe LNG?
Definitely. The whole Indo-Pacific region is a major focus. You've got the LNG Canada project backed by giants like Shell and Petrotina that's supposed to start shipping liquefied natural gas to Asia late 2025 or early 2026.
LNG, okay. That's another big avenue.
And there's even talk, exploratory work, about potential Arctic pipelines. That could open up direct routes to Europe as well as Asia. You hear political leaders mentioning it. Plus, diplomacy, Canada's trade minister has been in Brussels talking energy and critical minerals with the EU.
So it's pipelines, LNG, diplomacy, hitting it from multiple angles. Now, Canada and China have traded other things besides energy traditionally, right?
Oh, yeah. It's usually been a mix: timber, minerals, agricultural products like canola and grains, some precious metals, a fairly diverse basket.
But there have been some recent bumps in that broader trade relationship.
There have. We've seen Canada put duties on Chinese EVs, steel, aluminum, and then China hit back with tariffs on some Canadian farm goods. So it's not all smooth sailing.
Interesting. So while the energy ties seem to be strengthening dramatically, there's friction elsewhere. But you think energy could become the main story in Canada-China trade?
It really looks like it's heading that way. I mean, Chinese imports of Canadian crude jumped 22% in 2024 alone, hitting about 184,000 barrels a day.
Wow, 22% increase.
At that rate, energy could easily overtake agriculture as Canada's biggest export to China by value. And once those LNG exports start flowing, that will just solidify the trend.
So with all this U.S. trade uncertainty, the tariff threats, what's Canada doing generally to sort of wean itself off that heavy reliance on the U.S. market?
Well, the government put together a pretty substantial aid package, $6.5 billion, specifically to help Canadian businesses diversify away from the U.S.
How does that work?
It includes direct support for exporters trying to find new markets, help for the agri-food sector, low-interest loans for small and medium businesses looking to go global, things like that.
Okay, so practical support.
But it's also important to remember the U.S. needs Canadian energy too, right?
Yeah.
Especially heavy crude for its refineries. Some estimates suggest U.S. gas prices could jump significantly, maybe 75 cents a gallon, if that supply got seriously disrupted.
So there's still mutual dependence, leverage on both sides.
Definitely. But the overall effect of U.S. trade policy, maybe unintentionally, seems to be pushing Canada faster towards building these new alliances, reducing that historical overdependence.
Yeah, that makes sense. It's almost forcing their hand. Okay, let's broaden out again and look at this wider use of tariffs and trade disputes as, well, geopolitical weapons. We've seen quite a few examples lately.
We certainly have. That John Deere situation was pretty stark, wasn't it?
Yeah.
Trump threatening a 200% tariff if they move production to Mexico.
Yeah, 200% really highlighted that clash between a company trying to stay competitive globally, looking at labor costs, markets, and the political push to keep jobs at home.
Exactly. John Deere was arguing it was about global competitiveness.
And then the auto tariffs hit 25% on imported cars, light trucks, seemed aimed squarely at European, especially German, car makers.
It did. And the EU's reaction was pretty swift and unified, wasn't it?
Yeah, they condemned it immediately, started talking retaliation, digital taxes on U.S. tech firms, maybe airline restrictions, even banning some tech imports. It felt like unprecedented EU unity on trade action.
No, very strong response.
And Canada got hit with those same 25% auto tariffs. That must have sent shockwaves through Ontario's car industry.
Oh, absolutely. The auto sector is huge for Ontario, over 30% of exports. The potential job losses in places like Windsor, Hamilton, Waterloo, that was a massive concern.
And the Canadian government reacted strongly there, too.
Yeah, Prime Minister Carney condemned it, launched that $2 billion strategic response fund to help workers and companies. And interestingly, you saw that public reaction reports of flight bookings between the U.S. and Canada dropping sharply, people consciously trying to buy Canadian.
A real grassroots response alongside the official one. And it wasn't just cars. The steel and aluminum tariffs came back, too, right? Leading to more back and forth.
Exactly. The U.S. reimposed them on the EU, and both the EU and Canada hit back again, targeting U.S. goods that would hurt politically or key exports.
So layers upon layers of tariffs and counter tariffs.
But even amidst that, some underlying strategic ties like EU-Canada energy cooperation seem to hold up. It's also worth remembering these tariffs have domestic consequences in the U.S. to higher steel costs for U.S. automakers, for instance. GM stock even dipped on the news, raising wider economic worries.
It really shows how interconnected everything is, and that instability seemed to ripple into investment decisions, too. We heard about big Canadian pension funds pulling money out of the U.S. and putting it into Europe.
That was fascinating. Concerns about U.S. political and economic stability, directly linked to the unpredictable tariff situation, seemed to be the main driver. Big funds like Ontario Teachers, University Pension Plan, they were looking for safer havens.
And they saw Europe as more stable at that point.
Apparently so. It coincided with the S&P 500 dropping, while European stock indexes climbed. Looked like a broader shift of global capital. The U.S. dollar weakened, Europe seemed more attractive, maybe helped by things like Germany's big spending plans. Confidence in U.S. assets seemed shaken.
So trade policy uncertainty was literally causing capital flight. That's a powerful effect. And then there was that really strange episode, the alleged market manipulation around the sudden tariff suspension in April.
That raised a lot of eyebrows, didn't it? The Dow surges over 2,000 points right after tariffs are suspended for 90 days.
Which came right after a social media post from Trump saying, it's a great time to buy.
And just before that, the U.S. Trade Representative had basically said no suspension was planned. The timing was conspicuous.
And the reports of unusually high call option buying just before the announcement, that fueled the shock and pivot speculation.
Exactly. The idea that maybe someone knew something. Senator Elizabeth Warren called for an investigation, pointing out huge profits made by some investors incredibly quickly.
And the official response was?
I think the press secretary mentioned something about the art of a deal.
Definitely raises questions about transparency. Now, the EU also seemed to have its own playbook for responding to U.S. threats, especially targeting the tech sector.
Yes, that was quite strategic. When faced with a potential 20% tariff on all EU goods, they didn't just threaten tariffs back. They leveraged their regulatory power.
How so?
Targeting U.S. tech giants, Meta, Apple, Google, Amazon, using tools like GDPR, the Data Act, hitting them with digital taxes, focusing on specific areas like AI, EVs, batteries, where they have regulatory clout. And they have that new anti-coercion instrument, the ACI, as another potential tool.
So using regulation and data rules as economic leverage, not just tariffs, that's a different approach.
Wow.
And shifting back to China, if the U.S. really did ramp up tariffs, say to that 50% level sometimes discussed, what could China do in response?
China has quite a few options. They could raise their own tariffs further on U.S. goods. They've targeted soybeans, cars, electronics before. Could go higher. They could restrict exports of rare earths. They dominate that supply chain, and U.S. tech really knows them.
Ooh, that would bite.
Non-tariff barriers, too, just slow down customs for U.S. products. Maybe let their currency, the yuan, weaken to make their exports cheaper elsewhere. And keep building ties with other regions, ASEAN, the Belt and Road countries, plus diplomatic moves, signing trade deals with others.
A whole toolkit of potential responses really underscores how complex these disputes can get. And how did Mexico handle the U.S. tariff threats, particularly on auto parts? Their response seemed different.
It was quite measured under President Sheinbaum, calm but firm. Instead of fiery speeches, she held a big rally focused on national unity.
Interesting tactic.
But behind the scenes, lots of lobbying, talking to U.S. automakers, farm groups, reminding them how much they rely on Mexican trade and supply chains. Mexico also has leverage with energy, oil supply, And obviously, migration is always a factor.
So quiet diplomacy and leveraging existing connections.
Exactly. They had counter tariffs ready if needed, even talked about reopening USMCA talks.
Yeah.
But the first move was strategic engagement.
Got it. And finally, just revisiting Canada's reaction to the auto tariffs, that strong response seemed to really strike a chord domestically.
It really did.
Mm.
Prime Minister Carney's condemnation hit home. You saw the travel boycott, the Buy Canadian push, the boom in domestic tourism.
Mm.
It felt like a real moment of national unity.
Those protests in Toronto, the elbows up slogan.
Yeah, it showed a strong public resolve, backing the government's stance to protect workers and businesses. And they got international support, too.
It's so clear from all this. Tariffs, trade disputes, they're not just dry economic policy anymore. They're tangled up with geopolitics, national security, even identity.
Yeah.
So wrapping up this deep dive, what are the big takeaways for you?
Well, we've seen the EU wrestling with these China dumping concerns, facing tough choices between protecting industry and keeping prices low for consumers. We've seen Canada making a very deliberate strategic shift in energy exports towards Asia, largely driven by U.S. trade uncertainty.
Right.
And overarching all of it is this trend, tariffs and trade fights being used much more overtly as geopolitical tools, triggering complex reactions and countermeasures around the world.
And like you said at the start, these aren't just abstract issues. They hit home, affecting prices we pay, the security of supply chains where companies invest. It all has tangible effects.
Absolutely.
So for everyone listening, here's something to chew on. With tariffs becoming such a common geopolitical lever, and with global economic power potentially shifting, what kind of long-term strategies should countries be focusing on to keep their economies stable and competitive in this, well, this much more uncertain world?
That's the big question, isn't it? Lots to think about there, considering all the different angles and potential futures we've touched on.
Indeed. We hope this discussion gave you some food for thought. Thanks for joining us for this deep dive.